Hey everyone, if you're single, deciding how to file for Social Security benefits can be challenging. The truth is, you have to think about things that married couples don't. And in today's video, I'm going to dive into what every single person needs to know before they decide to file for Social Security. Now, first, we have to acknowledge the importance of getting this right. For a single person, the decision is even more important because you are all there is. There's no backstop of a spouse's ability to return to work or their assets and income. So we have to get this right. Now, before we get too far into it, if you haven't yet downloaded my Social Security cheat sheet, you should. This is where I've taken the most important pieces from the 100,000-page Social Security website and condensed it all down to just 2 pages. And as you're thinking through these Social Security decisions and living in retirement, this guide is going to be incredibly valuable. Now, I update it every year, and as long as you don't unsubscribe once you download this, I'll send out the new version as soon as it's updated. So let's jump into talking about how single people should approach filing for Social Security. First, you do have to recognize that your retirement planning process is unique and different from that of a married couple. Couples have to think about spousal and survivor benefits for current spouses, other assets and income of their spouse, the health of their spouse, and a few other considerations. But you, as a single person, should have a different approach. You still have to consider some of the same things, but their importance is not the same. But on the other hand, you also have a few differences that are particular to only single people. So today, I want to help you understand the complexities of filing for Social Security if you're single, whether or not you've ever been married, you've been divorced, you've been widowed. If you're single now and you're thinking about this decision, today's video is for you. So when we're moving through this decision process, I found that it generally makes sense to break it into 4 broad consideration points. Those are prior marriages. This is important because if you were married in the past, you could be eligible for spousal or survivor benefits. And then we have life expectancy. We use this to calculate a break-even analysis. And then we have your retirement income need. If Social Security on its own is going to meet your retirement income need, the decision becomes much easier. But whether your Social Security is sufficient on its own or not, this then ties us directly into the last consideration point, and that's your other assets and income. Now, be sure to stay tuned for this one because this has the potential to make a big difference in how long your money lasts and how much you have to pay in taxes. So let's jump right in with the first one and talk about prior marriages. Now, let me give you a warning here. When we're talking about spousal benefits and survivor benefits, this is a topic that we could spend the next half hour on, but I want to keep this succinct because I want you to get through all of these points. So in this video, I'll cover the basics, but if you want to dig in deeper, look for the resources section in the description, and I'm going to link up some other videos and articles I've written that's going to help you. So let's get started by diving into consideration point number 1, spousal or survivor benefits. So even though you're single now, you may still qualify for a spousal or survivor benefit if you've been married in the past. So let's break a spousal and survivor benefit down separately so we're really clear on this. For a single person to qualify for a spousal benefit, that means that they were married for at least 10 years before getting a divorce. A survivor benefit, on the other hand, can be paid if you were married for at least 10 years before divorcing or at least 9 months if you were currently married when your spouse died. Now, let me make an important note here. There are numerous exceptions for individuals who lost a spouse after a marriage that lasted less than 9 months. And in the resources section, I'm going to put a link to an article that goes into this in more detail. Now, spousal and survivor benefits are important because this adds another component to your decision, especially in the case of survivor benefits where you can file for only a survivor benefit as early as age 60 while you're letting your own benefit grow all the way up until age 70. Now, in the right situations, this can make a massive difference in the total amount of benefits that you'll receive. This takes us to consideration point number 2, life expectancy. You know, I'm not a fan of using this factor on its own to make a decision, and unfortunately, that's the only data point that some people use. But I do think that it's an important consideration point, and even more important for single people than it is married couples, because you don't have to think about the survivor benefit you leave behind for your spouse and a few other things. Now, the most common way that a life expectancy is used is through a simple break-even analysis. This calculation compares the total value of receiving lower benefits earlier to the total value of receiving higher benefits later. For example, if you decide to receive benefits at 62 instead of waiting till 67, you'll receive 5 years worth of benefits before you would have at 67. But your monthly benefit will be significantly lower once you reach 67. So you'd have to live past a certain age, referred to as the break-even age, to justify the decision to delay collecting benefits until 67. The same goes for any other age combination. Now, to help figure this out, we've built a simple break-even calculator that's free to use. I'm going to link that up down below in the resources. And if you want to kick it up a notch, then after you've used that calculator, you may even want to use some software that's more robust, like a tool like the Maximize My Social Security or the RSSA Roadmap software. That's going to give you some more information above and beyond what the break-even calculator will. But again, I don't think that should be used in isolation. So this takes us to consideration point number 3, and that is your retirement income need. Now, this third consideration is one that I think is the most important piece of a retirement income plan, and it's what everything revolves around. Your monthly net income need is the amount you need hitting your bank account every month. Now, this is important because your monthly net income need minus your Social Security benefit is the deficit that has to be met with other sources, and understanding what that amount is critical to getting your filing strategy right. If you don't know this number, you could end up filing at the wrong time and be left with a benefit that's permanently reduced and maybe not large enough to meet your retirement income goal. So the monthly net income goal has to be determined before you file. And thankfully, it's not hard to do. Now, my team has created a calculator here as well, and it was built to help you get to this number without getting overly complicated and having to create a spreadsheet that averages your last 5 years of expenses or anything like that. Now, I'm going to link this up down in the resources below, and when you click on the link, it's going to open up a no-frills page with a simple layout that's easy to use. And at the bottom of the page, you'll see the monthly net income need auto-calculating as you input your numbers. Oh, and it's completely free to use. You don't have to put in your email address or jump through any other hoops either. You just go to the page and start using it. Once you get that, then it's time to go to consideration point number 4, and that is your other assets and income. Now, if you have saved for retirement, you have assets in a 401k, an IRA, or any other type of retirement savings account, your Social Security filing strategy is going to require more careful planning. This is because having assets provides you with flexibility, where you can devise a strategic plan that coordinates account withdrawals with Social Security benefits. And if executed correctly, this approach can result in a significant tax savings and the preservation of your account balances for a longer period. For example, let's take Lisa. She has a full retirement age benefit of $2,750 and has $500,000 in her IRA. She wants $4,000 per month total net retirement income. So the question is, should she file at 62 and take part of her income from Social Security and part from her IRA, or should she delay filing for benefits, which would mean that she would have to take all of her income from her IRA up until the point where she filed for Social Security? So here's how the numbers would play out using today's dollars. Now, needless to say, all of this would be adjusted for inflation and taxes, so these certainly aren't the exact numbers, but I want to make certain this is clear, so we're just going to use today's dollars. So Lisa wants $4,000 per month in retirement income. So if Lisa's full retirement age benefit was $2,750, that would mean that she would need to withdraw $1,250 per month from her IRA. Now, if she files at 62, that would mean that she would receive $1,925 from Social Security and $2,075 from her IRA. And if she filed at 70, that would be $3,630 from Social Security and only $370 from her IRA. So to keep this simple, let's look at the Social Security filing decision based on those three filing ages: 62, 67, or for retirement age, and age 70. We could also look at all the other numbers, but for this video purpose, I don't want to get that chart that busy, so we're going to keep it isolated to just those three. So first, let's look at how filing at those various filing ages would affect her taxes. Then we'll look at the account balances. And be sure to stick around for that, because this is where we get into the real difference. Let's get started by looking at the cumulative taxes throughout her retirement. And keep in mind, the net income either way is the identical amount. In each case, now we are adjusting for inflation every year. The only thing that's different here is the Social Security filing age. So let's look at all the ages, and let's stop the chart at about age 75. Now, the green line is the cumulative taxes if she files at 62. The yellow line is the cumulative taxes if she files at 67, or her full retirement age. And the red line is if she files at age 70. Now, you'll notice at first that the green line, filing at 62, has the lowest cost of taxes in the first few years. And this is because some of the income is coming from the IRA, where it's all taxable, but a good part of it is coming from Social Security, which is partially tax-free. But at about age 69, the cumulative tax cost for filing at 62 exceeds the cost for both filing at age 67 and 70. And by 71, the tax cost for having filed at 62 will exceed the cost for filing at 70. And when we bring the rest of the chart in, you can see that by age 80, the difference is just over $47,000. And by 85, that difference is $55,000. So the tax cost of various filing strategies is certainly one piece you want to consider. But there's another data point that's just as important, if not more so, and that's how do the filing strategies affect her IRA balances? Do any of those filing strategies ever put her at risk of running out of money? If she files at 62, you can see that there's never a very large drawdown from the IRA because a large part of her income is coming from Social Security. So the account value stays fairly level throughout her retirement. But if she delays until 67, you can see that there is a decline between 62 and 67 of about $100,000. And that's because she doesn't have any income from Social Security, and the IRA is bearing the load of all of her retirement income during that period. But once Social Security kicks in and the withdrawal amount is less, the growth slowly starts exceeding the withdrawals, and around age 84, the balance catches back up to where it would have been if she would have filed at 62. Then we have filing at 70. Now, this gives you the same initial picture at 67, but you can see that the decline goes much deeper. This is because she's drawing all of her income from her savings for a much longer period of time. In this case, the portfolio value drops by over $200,000, and it takes it all the way to age 87 to catch up to what it would have been if she would have filed at 62. Now, here's another data point to consider. How comfortable would you be with nearly one half of your portfolio being used just to increase your Social Security benefit? For some, the longevity insurance of getting a larger Social Security benefit would be well worth it. But for others, this is getting too close to depleting their accounts. And I can tell you that after walking the road with a lot of retirees from the time they left their job to their death, this would not be acceptable. And this highlights yet another problem I have with this. Remember that we're using linear rates of return for these charts. In fact, we're using the JP Morgan long-term capital market assumptions. And when you're looking at cash flows, that's really the only way to do it. Otherwise, we're just picking a return scenario out of the air, and we know that won't be right either. But therein lies the problem. What if things don't go perfectly in those years between 62 and 70? What if you have a negative year or two? Then things can get ugly. There's one big takeaway from this, and I say this all the time. If you're a client of mine, you've probably already heard it. Retirement planning is one half data and one half emotion. You have to be able to get the data and then determine how you feel about it. I can tell you that some would like the idea of filing at 70 purely because of the tax savings, while others would look at this and say, There's no way I'm spending my IRA down just to get a larger Social Security benefit. And how you feel personally is really up to you. But first, you have to get the data. And that's where we can help you. If you want to make sure you have a plan that's not going to cost you too much in taxes and expose you to too much risk, that's where we come in. The charts that you just saw and a lot more are in every plan we do. So if we can help, just let us know. If you want clarity, there's going to be a link down below where you can directly access our calendar and schedule a call. Thanks for watching.